Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, founder at TJ Stearns Inc., always providing us with a little dose of common sense in a chaotic financial, investment, and economic world. Down-to-earth advice for your money, your investments, your retirement planning, ladies and gentlemen. And Tim, we always appreciate the perspective.
Peter, thanks for having me.
And it is indeed a pleasure each and every week when we get to connect with you, Tim. And ladies and gentlemen, I want to remind you as we get going, you have the opportunity to connect with a certified financial planning professional, Tim Stearns, CFP, personally as well, to discuss and look over your individual financial questions or concerns and identify risks, issues, and opportunities in your planning progress. All you need to do is pick up the phone and give a call, 800-640-2256, 800-640-2256. 800-640-2256, or you can go online, tjstearns.com, tjstearns.com. Tim, today talking about what kind of investor are we? I am the kind that likes to make money, and I think a lot of people share that perspective, right?
Well, I would agree with that. Two things kind of motivate us in the market. It's fear and greed, right? And I think the last, 12, 13 years, it's been greed. People think that this show can't stop, right? That it's just going to keep going on, making money. Many people think over the last, 25 years or so that the market's averaged 10% a year, and that's kind of the number they go off of. I feel that's super aggressive. When we are doing financial planning for people, we never assume a 10% return. I find it very interesting when a client comes into me and shows me some sort of illustration from their former advisor that says that they're going to make 10% at a clip per year, when, as we know, in 2022, the market lost on average 18 to 32%. If you're in the NASDAQ, was 32% negative, and then the 18% was the S&P 500. The averages I'm seeing coming in here are at least 20% down. So that kind of blows apart that example that we're going to make 10% every year consistently. I've never seen that in my 29 years in the market.
Right. Yeah, Tim, it's not just the 10%, but it is that the 10% is going to happen year in and year out consistently in these projections. And I've always took issue with that, had a problem with that as well. But the reality is that 10% even something that is based in reality, right? Because if we look back over the history of the market and the perception and what we are told, well, the market has averaged 10% over time. Well, in reality, the S&P 500, you've got a chart that you shared showing the real world returns of the S&P from January 1st, 2000 through December 31st, 2022, a pretty good period of 23 years in the market. But the S&P over that period of time, a compound annual rate of return of only 5.78%. So that's a far cry off. And that's if we are taking on the full risk of the market, which most investors don't have the stomach for.
No, not at all. And, when you're assuming 10%, that assumes every dollar that you have is in the stock market. And, even a bad advisor knows that all of your money shouldn't be in one basket, right? If you're a do-it-yourselfer, that just goes without saying that you're going to have some money in cash, you're going to have some money in bonds. I spoke to one of my clients the other day, and he was upset that we hadn't outperformed the index the year in 2022, as far as stocks go. And I said, well, that's because we're in a fixed income portion that had daily stop losses. And that portion lost only 6.9% as opposed to the Barclays bond aggregate lost 13%. So you need to make sure that you're comparing apples to apples. And that's what I was trying to explain to them. The other thing I keep telling people, especially baby boomers, you are not 40 anymore. You cannot take a hit. The last thing you want to do is have the cheese moved further down the road because you can't get there because your money took huge losses like last year. And I have so many people from 2008, even last year. Boy, if it gets back to where it was, I'll never take that much risk again. Take that to heart. You aren't 40 anymore. You need to invest to appropriate strategies of your age group. And if I'm winding down my career, the last thing I want to do is take a 20% hit of what my market value was.
Because oftentimes, Tim, accounts have gone unattended to, kind of hands off the wheel, become out of alignment, and then people are taking more risk than they are even aware of. We saw a lot of that over the last decade.
Oh, exactly. And the other thing that has caused a lot of that is we have these target date funds. And I read a great article about how it's the Ozempic of the financial markets. And what they mean is that Ozempic has been shown to have people lose weight extraordinarily with the shots. What that does, though, is that the article was saying, shouldn't we educate those people on what is proper to eat, what their diet, exercise should be, and these target dates are kind of doing that. You have a lot of people out there who are saying, I don't need an advisor, I have a target date fund. But what that does is it puts you on almost a robotic strategy that is just going to, they still took hits last year. We saw the 2015 Vanguard fund was down 15%. So 2015, yeah, you heard my dates correct. I know it's 2023, but they still have a fund out there, 2015, that lost 15%. Right. So what I'm saying is that no one is teaching clients out there how to decumulate, and that goes with having an advisor. And it's been shown that advisors, we over time have done better than the average investor.
Well, if you want a plan, ladies and gentlemen, that is based in reality and deals with the true nature of the market, that it is not predictable, that there will be up years, but yes, there will be down years as well, and yet still provides for lasting financial confidence through those times, you need to have a plan. And that is what the Protect and Grow plan is geared to help clients accomplish. And Tim Stearns and the team from TJ Stearns Inc., they put together the Protect and Grow plan, a written retirement income plan for their clients there and for radio show listeners, podcast viewers. If you would like to take advantage of this offer and opportunity, pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, we've mentioned the word risk a lot already in the program. And to me, risk is really any kind of variable that can impact us that is outside of our control. But in the context of the question of the program, what kind of investor are you? We're really talking about market-based risk, the direction and the velocity of the stock market, right?
Exactly. We really are. You want to make sure that you are smarter than a lot of people I'm seeing out there that are just being aggressive without knowing that they're out there doing that. And what I mean by that is that they've had the stocks take over such a big portion of their portfolio that they're so stock centric that last year they took a bigger hit than they should have. And that's where an income allocation plan comes into play to make sure that you're analyzing and seeing kind of where you're at as far as risk goes. And, I think a lot of people can't figure that out without taking a good analysis. And that's why we do that risk analyze for people to show them, hey, you've got over 80% in stocks here. No wonder 2022 was terrible for you. Let's get smarter about this.
Thankfully, though, Tim, I mean, this year so far has been more stable and generous than last year, certainly, and than many of the so-called experts believed this year would be, from all the talk and the discussion at the beginning of the year about the 2023 coming recession. And yet still, investors are, I think, reasonably cautious and paying attention. To your point, the time to assess your risk exposure, though, is not at the bottom after we've already lost money. Right. It is right now, right? The market's been generous. Let's take advantage of the market's generosity, evaluate and assess our risk exposure, and then make sure it's in alignment with our needs and our tolerance and our time horizon.
What I'm saying is, most of the people that I've talked to who have other advisors, they're just clawing back to where they were at the beginning of 2022. So to me, once again, you have a do-over. And, to have a do-over in the market is a great gift, and take advantage of it. And that comes into having a plan, and having a look at what exactly you have going on there. And what do you want your portfolio to do? Do you want it to grow? Do you want it to throw off income to you? How are you getting to the finish line, which is a successful retirement? And I don't think a lot of people do that. 1 out of 10 Americans actually have a written plan. And I'll preach to this all day long. We talk about that in our college classes, which again, right now we're in the throes of having classes in the Chicagoland area. People can Zoom them. People can come see us in person, but all they need to do is give us a call.
And again, if you would like to find out when those classes are being held, when and where, and maybe sign up for one that is nearby you and a convenient time, pick up the phone, give TJ Stearns Inc. and Tim Stearns CFP a call at 800-640-2256, 800-640-2256. It's striking, Tim, that you mentioned only 1 in 10 have that retirement income plan, and juxtapose that with the fact that running out of money is such a high and prevalent concern amongst retirees. Well, maybe if we formulated the plan to address that concern, we would have less of it. Now, taking risk in the market historically has paid off over time for investors who can stay invested, right? Even during those down times, they say just don't sell right now. Don't
Right.
lock in those losses. The market will come back, and the market historically has not only always come back, but has surpassed previous highs. The difference, and I think the important factor here, Tim, is that in retirement, when we are utilizing those investments to create income, to create cash flow, to pay our bills and support our lifestyle, we cannot, by definition, follow that advice. We have to sell out during those down times and good times, but during down times, we lock in those losses. That can be very detrimental to the outlook and the forecast for our retirement well-being and stability.
Let's take a look at that. If you had $1 million and you lost 20% of that, you're down to $800,000. And now my utility bills come, right? And I have to pay them, because I want to keep the lights on. I want to keep my house warm. I want to keep my house cold if it's as hot as it's been lately, right? At the end of the day, I'm going to have to sell some of that portfolio to pay my bills. Most of us don't have pensions, right? And the pittance that you get from Social Security isn't going to cover all your bills. So now I'm dipping into, my portfolio that has already gone down, and I'm locking in those losses. I mean, it's very decimating to a portfolio to have to do that, because you'll never get that money back from the upswing in the market. And that's why we talk to people about having a plan. If you have, like, for example, an annuity that would pay off that per month, if the market's down, your utilities are being paid by the income that you're receiving from there. And interest rates are so high right now, the payouts that they're locking in at these different insurance annuities is outstanding. It's the best I've seen in my whole 29 years of my life as a financial advisor.
Tim, on the other side of that coin, so to speak, though, is the growth and opportunity that the market provides and allows us access to. And we know that we need some growth and horsepower on our money over time. So how does an investor make a decision on how much risk to take? How do we find that correct balance of our money is at least keeping pace or outpacing inflation with the true need of our money in retirement, especially to create that income? And is that why inflation is especially impactful for retirees, or one of the reasons?
Well, the rule of thumb used to be 100 minus your age is what you should have in stocks versus bonds. So if I was 50 years old, I should have 50% on each side, bonds and stocks. We're not seeing anywhere near that. I'm seeing easily 60, 70%, 80% in stocks. And that's why they really took it in the shorts last year, as far as getting, clipped by the stock market. So now they're coming back up to where they were. And I think, again, this is a do-over example where you could actually allocate some money into some other, non-correlated assets to the market. There's cash out there, annuities, maybe even some commodities that would do that, or having stop losses, having active management. It's not your grandpa's stock market anymore, so you shouldn't behave that way, and you shouldn't be, investing like you're still 40 years old and you have 25 more years to work. A lot of the baby boomers are coming to the trail's end here. We need to make sure we take care of the money. That comes with an income allocation plan.
Yeah, Tim, when I asked the question and you went to age, it sort of it hit in my mind that at 30, let's call it, if we had a 10-year work history and then the market went down 25%, we've really only lost about 2.5 years of progress, we'll call it. But
Right.
at age 60, if we've had a 40-year working career and the market goes down that same 25%, we just lost 10 years worth of our work in progress. And really, in either scenario, it's actually more than that, because the time value of money, right, is the money grows over time. So it's actually even a larger, but the point being that the older that we get, the same market downturn represents more years of our progress that just got washed away.
Exactly. So why not get a hold of yourself and make sure that you retain what you've made? And that comes with having a plan. And I will say that ad nauseum, but if you have a plan, you don't have to take out money out of that stock portfolio that's gone down, And then, the flip side is I see a lot of people sitting in cash still. Well, that's not staying up with inflation. Inflation, is at 3.01%. A lot of people are just sitting in a savings account that's not even taking advantage of these higher interest rates. So, everything needs another look, what's under the hood, and make sure that you know exactly where your money is, how hard it's working for you or not working for you. And we'll take a look at everything, risk versus reward versus inflation, and then definitely having a plan.
It is all part of that Protect and Grow written retirement plan, ladies and gentlemen. If you would like to get that put together, no cost, no obligation. By the way, similar plans across the Chicagoland area, across the nation, can go upwards of $1,000 to a couple thousand, several thousands of dollars. But Tim Stearns, CFP, your certified financial planning professional, makes this available to you as a resource and as a service to you. No cost, no obligation. Pick up the phone, give a call if you'd like to take advantage. 800-640-2256, 800-640-2256. So Tim, talking high level, how much risk we should take, actually quantifying that, there's a couple measures. There's risk tolerance and risk exposure. How do you help your clients measure and quantify these two factors, risk tolerance and risk exposure?
Well, it's funny that you asked that. So risk tolerance, you ask someone, well, where are you at? Are you conservative, moderate, aggressive, somewhere in the middle of those? Okay. That would be the risk tolerance, that you can handle a downturn of 10%, 15%, 20%. How does that make you feel? All right. And then you'll ask people, well, what's your risk exposure currently? And they really don't know, And so what we do is we actually put it into our software to show them, here's what happened, and you actually lost more than you're even comfortable with doing. So sometimes, you have to kind of put the person's nose in it a little bit to show them that your risk tolerance does not match up with your risk exposure. And that comes with the risk analysis that we do. And we provide that for free for people, because that's how much we believe in it. We want to give something back, showing people, hey, be careful. The last thing you want to do is say, hey, to your spouse, I have to work another 5 years because I was thinking that the gravy train of the stock market was going to go on and on and on, and it didn't. That's the last thing you want to do. So, and you also don't want to be sitting there putting your money into just cash and because you're heading for the hills. I get that too, but there has to be balance and a moderation of that.
And a self-reflecting kind of question, do we think that the next 5 or 10 or 20 years are going to be as good as the last 5 or 10 or 20 years have been? I mean, we've been through the interest rate spike and rising Fed rates of 2022. We've been through COVID. All told, though, the last 10 to 15 years, including the tail end of the Great Recession, even, I guess, would be included in that time, Tim, fantastic growth in the market. a good time to be an earner and an investor.
Yeah.
But as we are turning the corner here, have our needs and the way that we should treat our money, has that changed? And then B, how confident do we believe that the next 10 to 15 years is going to be as good as the last 10 to 15 years? And I feel like there's kind of an overwhelming sense that maybe we have a little bit more difficult time coming up into the future.
Well, your needs are going to change because you're not adding money to the bucket anymore, right? Whether it's a growth bucket or a fixed income bucket, you're going to be a net seller of assets. We talk about that all the time on this show, that whatever you have at the end of the day of your career, besides growth in the stock market, it's not going to go up. In fact, in most cases, it's going to go down, right? Because I'm going to be taking money from it to live on. So your needs have definitely changed. And you have to be cognizant of the fact that you're entering a new area where you don't want to run out of money, but you want to enjoy your life, so that comes with having a plan. You would never build a house without a blueprint. You need a blueprint for retirement.
I mean, if you'd like to get that blueprint put together, pick up the phone, give Tim Stearns, CFP, TJ Stearns, a call, 800-640-2256, 800-640-2256. I love the blueprint analogy, Tim, because if we're building a house, we've got a contractor that we're interviewing and we say, well, why should we hire you to build our house? And they say, well, I've got this hammer, I've got this drill, I've got this screwdriver. Fantastic. I mean, those tools will probably be necessary, right? But unless they've got a plan, we might not even know where those tools are needed to be used. And that's what a lot of investors have, is that we've got these tools. We've got the investment accounts. We've got the 401ks. We've got the IRAs. Fantastic. Those are probably essential tools, but they are not the plan. They are not the blueprint. The blueprint is what tells us where each one of those pieces and tools is going to be needed to build our dream house, so to speak, to complete the analogy of the blueprint there, Tim. You talk about that blueprint all the time, the Protect and Grow plan. Yep. That is that blueprint. That shows savers and investors and proactive planners where each one of the tools is going to be needed and how it can be utilized.
Yes. And, we talk about that a lot. And in the book that we just published, the Retirement Riddle, it's we put it together over the years, you and I, and it's just a good summary of what you need to do in your retirement as you go into retirement phase. And we're happy to get that book out to people. All they need to do is give us a call, but I'd like to do it for the top 10 callers because we're giving that out in our college classes. It's part of the curriculum, and I think it's a great book. Most people that have read it have said that it gave them a lot of things to think about, things to act on, and things to strategize about.
Yeah, riddle. Oftentimes, Tim, you got to think about it a little bit differently. You got to think a different angle to answer the question. And that's really, it seems to be what retirement is with the traditional thinking status quo of the financial world to this point. We've got to think about things a little differently. The Retirement Riddle, fantastic book, ladies and gentlemen. And for the first 10 callers, you can call in right now, request your copy of the new book, The Retirement Riddle. 800-640-2256, 800-640-2256, 800-640-2256. It does not just ask the question. It really helps and encourages you to rethink and talks about some of the solutions to the major questions of retirement. The Retirement Riddle, again, if you'd like your copy, be one of the first 10 callers, 800-640-2256, 800-640-2256. Tim, you mentioned the changing needs that we have when we move from the working career to retirement. Does that not mean that our approach to investing should also change and that our expectations from those investments may also be appropriate to reconsider and reevaluate as well?
You're no longer putting money into your retirement plan, then you need to take the gas off, and have a little bit less risk in the portfolio. What does that look like? Well, there's different ways to approach that. But that is something that you need to have a discussion with a certified financial planner practitioner like myself that will actually define what that looks like. It's so important to know exactly what your portfolio is doing and why. And I don't think a lot of people have that. They just think accumulation. No one is teaching anyone how to decumulate safely. you got people running scared now, and that's another reason to have a plan.
Once again, if you'd like to get that plan put together, the Protect and Grow plan, if you'd like a copy of that book, The Retirement Riddle, pick up the phone right now. You can take advantage of either or both of those offers. 800-640-2256, 800-640-2256. Bringing it full circle, Tim, you talked at the beginning of the program about whether we are conservative or moderate or aggressive. And I know that we've all heard this tale that the market has averaged 10% over time, and as an investor, our goal should be to try to beat market returns. But that's actually a very highly aggressive, maybe even speculative kind of approach to take, because if we're trying to beat the market on the way up, then we probably also lose more than the market on the way down. And most investors actually don't have the stomach for that. So do we need to temper our expectations if we do qualify ourselves as a conservative or moderate or maybe even moderately aggressive kind of investor?
When you're doing a financial income allocation plan, the most aggressive we'll use is a 6%. The Department of Labor says when you're doing an income allocation plan, 6% is the high, 5% is the moderate, and 4% is the conservative. So when we do a plan, we want to underpromise, overperform. And that's what you need. So yeah, you have to take a look at your portfolio. Is not going to all be in stocks that are going to be, killing it year after year consistently. Guess what, guys? The stock market does reset every 5 to 6 years on average in the last 100 years. So we need to be more cognizant of that and take better care of our money.
And the Dalbar Research Institute publishes an annual study on investor behavior and returns. And for 35 years, it has consistently shown that investors on their own actually underperform not only the market by a wide margin, but also investors that utilize the services of an investment financial professional, of an advisor who helps them keep their plan on track. And ladies and gentlemen, again, that's what Tim Stearns is here to help to provide, not only the information, education here on the program, but to be that resource and advisor and to put together the plan that you can refer back to help you have confidence you're making that financial progress. If you'd like to get your Protect and Grow plan, if you'd like to get your copy of the new book, The Retirement Riddle, pick up the phone now, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, always a pleasure having you on the program. Thank you for being here.
Thanks, Peter.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.